everybody, Bill Drexler here, and if I haven't met you yet, I am a certified financial planner with Financial Cornerstone Group. One of the main types of folks that we love to help out are our friends and family who are nearing retirement. So we're doing a lot of retirement planning, looking at investment management, looking at retirement projections, and one of the things that we've noticed is that you have to spend a lot of time on doing tax planning, as well as looking at inflation. So if you're not focusing incorporating taxes and inflation into your projections and looking at the rest of your life, whether it's 20, 30, 40 years in the future, that's going to have a big impact on your plans. And so in this video, I wanted to talk about 7 types of income that are not federally taxed in retirement. And I hope this helps. So first up are qualified Roth IRA distributions. And we're going to throw something up on the screen real quick. There are a couple rules that you need to know to be able to take your Roth IRA earnings penalty and tax-free. So at first, let's say that you're older than 59 and a half and that you've owned the account for more than 5 years, or you've owned a Roth for 5 years. At that point, you can withdraw earnings tax-free and it is penalty-free. Let's say that you're older than 59 and a half and you've owned the account for less than 5 years. So you have to pay income tax on the earnings, but no early penalty on the withdrawal. If you're younger than 59 and a half and you've owned the account for more than 5 years, you typically owe taxes and a 10% income on the earnings that you withdraw. There are a couple situations where you'll be able to get exemptions on that, disability, first-time home purchase, things like that. And finally, younger than 59 and a half and you've owned the account for less than 5 years, you typically owe income taxes and a 10% penalty on the earnings you withdraw. So the second thing we're going to talk about is life insurance proceeds and loans. So payouts in the form of a death benefit are not federally taxable. However, if you have earned interest from earnings that could be withdrawn, those might be subject to taxation. And loans from cash value accounts can also not be federally taxed, as the IRS considers it a loan. There's actually a section 7702 of the IRS tax code, that if the contract passes both the guideline premium and the corridor and cash value accumulation test loans, loans from those contracts are not federally taxed. All right, so next up on the list, we have municipal bond income. So a municipal bond is a debt instrument to a local or state or municipality, a local government used to raise capital for various projects, roads, bridges, things like that. And interest payments from those loans, they're not subject to federal taxation. They're tax-free at that level. However, it is worth noting that they are added to your provisional income calculation, and that's the calculation that the IRS uses to decide if your Social Security benefit is going to be taxable. I actually did a seminar and I made that into a video and uploaded it to our channel, so you can click and watch that for a little bit more in-depth talk about provisional income. So also worth noting is the fact that it's not free of any capital gains. So if you sell that particular bond at a gain and at a premium, that difference is subject to capital gains as well. So next up on the list, we have HSA withdrawals. So HSAs, or health savings accounts, they have wonderful benefits that we can take advantage of in retirement, and they're mainly used for healthcare costs. So in short, your contributions to an HSA can be tax deductible. They grow tax-free, similar to an IRA, and withdrawals are tax-free if they're used for eligible medical expenses. And that list is actually quite extensive. So next up on the list are Social Security income payments. If you're below provisional income amounts, I have a whole nother video on provisional income, like I mentioned earlier. Feel free to check that out. It's more detailed and it goes into a little bit more in depth in that topic. However, for this video, provisional income is a calculation that the IRS uses to decide how much of one's Social Security is going to be subject to taxation. And consider the next graphic. So let's go ahead and throw that up on the screen here. So if your provisional income falls under $32,000, if the calculation comes out that it's under $32,000, the percentage of your Social Security that is subject to taxation is at 0. If your provisional income falls between $32,000 and $44,000, up to 50% of your benefit is subject to taxation. And if your provisional income calculation is over 44,000, up to 85% of your benefit is subject to taxation at whatever bracket that you're at. So next up on the list are reverse mortgage payments. The federal government considers these to be loans as well and not income. So therefore, reverse mortgage payments are not federally taxable. However, keep in mind that as a loan, you are subject to paying back that loan. Finally, we have gains from selling your primary residence. So in retirement, a lot of folks might want to investigate at least downsizing, selling their home. And you can sell your primary residence and be exempt from capital gains taxes on the first $250,000 if you're single, $500,000 if you're married and you file jointly. It's also worth pointing out that the 2 and 5 rule, in which you need to have lived in that home for the last 2 of the 5 years that you've earned it for it to qualify as your primary residence. Remember to always consult a CPA, your tax professional, and in conjunction with a certified financial planner, a fiduciary that's going to take a look at your unique situation and help you plan for your specific retirement needs. So I hope that this helped. If it did, please leave a like, subscribe, share it. We'll see you in the next video. And as always, be good to yourself, be good to everyone else. Thank you. Appreciate it.